In this video, we'll show you 3 AI stocks that still look surprisingly cheap despite sitting at the center of one of the biggest technological revolutions in history. These are dominant businesses with massive competitive advantages, enormous cash flows, and positions that could become even stronger as artificial intelligence transforms the global economy. And while many investors assume the AI trade is already overcrowded, these 3 stocks suggest the opposite. Let's start with the first company, Microsoft, ticker symbol MSFT. If you only looked at Microsoft's stock chart this year, you might think something is seriously wrong. The shares have fallen more than 20% in 2026. For many investors, a drop like that immediately raises questions. Has growth slowed? Is the AI boom fading? Are competitors catching up? But when you actually examine Microsoft's business results, the story becomes almost impossible to ignore. Because while the stock has struggled, the business itself has been doing exactly the opposite. In fact, Microsoft's AI business is growing at a pace that most companies can only dream about. The company recently revealed that its AI business now operates at an annual revenue run rate of roughly $37 billion. Let that sink in for a moment. A few years ago, investors were excited when software companies generated a few $100 million from AI products. Microsoft is now generating revenue at a pace measured in tens of billions. Even more impressive is how quickly that business is expanding. During its most recent quarter, Microsoft's AI revenue grew by 123%. Not 23%, not 53%, 123%. Those are growth rates normally associated with small emerging companies. Microsoft is one of the largest corporations on Earth, yet one of its most important growth engines is still accelerating at triple-digit rates. That disconnect between business performance and stock performance is exactly why investors should pay attention. Because when great businesses temporarily fall out of favor, opportunities often emerge. And Microsoft isn't simply benefiting from AI hype, it's becoming one of the foundational infrastructure providers powering the entire AI economy. Think about what happens every time an enterprise adopts AI. The models need computing power, they need cloud infrastructure, they need storage, they need cybersecurity, they need data management, they need enterprise software integration. Microsoft is positioned to benefit from virtually every one of those requirements. The company isn't betting on one AI product succeeding, it's supplying the tools, infrastructure, and ecosystem that thousands of businesses rely on to build their own AI strategies. That is a much more durable position, and nowhere is that advantage more visible than Azure. Azure has quietly become one of the most important assets in the AI race. While many investors focus on consumer-facing AI products, the real money is often made underneath the surface. Just as the California gold rush created fortunes for suppliers selling picks and shovels, today's AI boom is creating enormous opportunities for companies supplying computing infrastructure. That's exactly what Azure does. During the latest quarter, Azure revenue grew 40%. Again, that's a remarkable number for a business already generating tens of billions of dollars annually. It shows that demand for AI computing power remains incredibly strong. Companies across industries are investing heavily in AI capabilities, and many of them are doing so through Microsoft's cloud platform. The more AI adoption increases, the more demand Azure can potentially capture. And unlike many technology trends that come and go, cloud computing has become deeply embedded into how modern businesses operate. Once customers build their systems around a cloud provider, switching becomes difficult, expensive, and disruptive. That creates powerful customer retention, it creates recurring revenue, and it creates long-term cash flow visibility. Investors often underestimate how valuable that combination can be. What's especially interesting right now is that Microsoft appears to be getting very little credit for these growth drivers. The market seems focused on concerns about AI spending, competition, and overall technology sector valuations. But those concerns become much less convincing when you examine the numbers. Remember, Microsoft's AI revenue is growing more than 120%, Azure is growing 40%, the company continues generating massive cash flow, and it remains one of the most diversified technology businesses in the world. This is not a company dependent on one product. Microsoft has multiple engines driving growth simultaneously: Windows, Office, Azure, LinkedIn, GitHub, gaming, enterprise software, cybersecurity. And now, AI. That diversification matters because it reduces risk while creating multiple opportunities for expansion. If one business slows, another can pick up the slack. Few companies have that luxury. Even fewer can combine that diversification with Microsoft's scale. Now let's talk valuation. Because growth alone doesn't make a stock attractive. Price matters. Even the greatest business can become a poor investment if investors pay too much. But that's where Microsoft's story gets particularly interesting. Many investors still think of Microsoft as an expensive technology stock. Years of strong performance created that perception, but perceptions don't always match reality. Microsoft's fiscal year ends on June 30th, which means looking only at near-term earnings estimates can sometimes distort the valuation picture. A better approach is to look further ahead. Using projected fiscal 2027 earnings, Microsoft currently trades at approximately 20.4 times expected earnings. At first glance, that may not sound particularly cheap. But compare it with the broader market. The S&P 500 currently trades around 21.5 times forward earnings. Think about what that means. The market is assigning Microsoft a valuation multiple below the average company in the S&P 500, not above, below. Yet Microsoft's growth profile is dramatically stronger than the average S&P 500 business. Its AI segment is growing at triple-digit rates. Azure continues delivering exceptional expansion. The company has a decades-long history of adapting to major technological shifts, and it possesses one of the strongest balance sheets in corporate America. If you were creating a list of businesses most likely to benefit from artificial intelligence over the next decade, Microsoft would almost certainly appear near the top. So why should it trade at a discount to the average company? That question alone highlights why some investors view the stock as undervalued today. The market often becomes overly focused on short-term narratives. When a stock falls 20%, investors instinctively assume future problems are coming. But sometimes the opposite is true. Sometimes a stock declines while the business quietly becomes stronger. Microsoft appears to fit that description, and history provides a useful lesson here. The company has repeatedly reinvented itself. Many people remember Microsoft primarily as a Windows company. Then it became an enterprise software powerhouse. Then it transformed into a cloud computing leader. Now it's establishing itself as one of the dominant players in artificial intelligence. Each transition created new growth opportunities. Each transition generated skepticism, and each transition ultimately rewarded long-term shareholders. That's not an accident. It's a reflection of management's ability to recognize technological shifts and adapt before competitors do. That adaptability may be Microsoft's most valuable asset. Technology changes constantly. The winners are rarely the companies with the best products today. The winners are the companies capable of evolving tomorrow. Microsoft has demonstrated that ability repeatedly across multiple decades, and that track record becomes especially important during transformative periods like the AI revolution. No one knows exactly how artificial intelligence will evolve over the next 10 years, but Microsoft doesn't need to predict every outcome. It simply needs to remain deeply embedded in the ecosystem. So far, that's exactly what it's doing. The company has positioned itself at multiple layers of the AI value chain: infrastructure, cloud computing, enterprise software, productivity tools, developer platforms, and consumer applications. That broad exposure gives Microsoft numerous ways to win. If AI adoption accelerates, Azure benefits. If businesses integrate AI into workflows, Microsoft 365 benefits. If developers build new AI applications, Microsoft's platforms benefit. It's a powerful strategy because success doesn't depend on one single product becoming dominant. The company can participate across the entire ecosystem. That's one reason why many long-term investors remain optimistic despite the stock's recent decline. They're focusing on where the business could be several years from now, rather than where the stock happens to be today. And when you combine a growing AI business, accelerating cloud demand, a valuation below the broader market, and one of the strongest competitive positions in technology, the investment case becomes difficult to ignore. Microsoft may not be the most exciting stock in the AI space. It probably won't double overnight. But investing isn't about finding the most exciting story. It's about finding businesses capable of creating value consistently over long periods of time. Microsoft has been doing exactly that for decades, and today, the market appears to be offering investors an opportunity to buy that quality at a surprisingly reasonable price. Which brings us to the second AI stock on our list. And unlike Microsoft, this company is generating enormous cash flow from a business that billions of people use every single day. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second AI stock that still looks surprisingly cheap is Meta Platforms, ticker symbol META. If Microsoft represents the infrastructure side of the AI revolution, Meta represents something entirely different: attention. And in today's digital economy, attention is one of the most valuable assets in the world. Every day, billions of people open Facebook, Instagram, Threads, and WhatsApp, They scroll, they watch videos, they message friends, they discover products, they interact with content, and every minute they spend inside Meta's ecosystem creates value for advertisers. That's why it's important to remember something many investors overlook. At its core, Meta is still an advertising company. Artificial intelligence may be grabbing all the headlines, but advertising remains the engine that powers the business. And that engine continues firing on all cylinders. During its most recent quarter, Meta grew revenue by an incredible 33%. Think about how impressive that is. This is not a small company. This is one of the largest businesses on Earth. Yet it's still growing revenue at a pace that many younger technology companies would envy. Normally, when investors see a company growing revenue by more than 30%, they expect a premium valuation. But that's not what we're seeing here. In fact, Meta currently trades at an even lower forward earnings multiple than Microsoft. That's what makes this situation so interesting. The market appears increasingly skeptical about Meta's massive investments in artificial intelligence, and that skepticism may be creating an opportunity. To understand why, let's first look at what Meta is actually doing. The company is spending enormous amounts of money building AI infrastructure, data centers, custom chips, advanced models, talent acquisition, research initiatives. The spending is so large that some investors are beginning to worry. They're asking a simple question. Will Meta ever generate an adequate return on all this investment? It's a fair concern. After all, building AI capabilities isn't cheap. The company is committing billions of dollars to a future that remains uncertain. And Wall Street generally dislikes uncertainty. Markets prefer predictable outcomes. They prefer visible returns. They prefer easy calculations. Meta's AI investments don't fit neatly into those categories. As a result, some investors have become cautious. But here's where things get interesting. Even if Meta's AI ambitions take longer than expected to pay off, investors still own one of the strongest advertising businesses ever created. That's the part many people seem to forget. Meta isn't betting the entire company on AI. It's using profits generated by a dominant advertising machine to fund future growth opportunities. That's a very different situation from companies that need AI success simply to survive. Meta already has a wildly profitable core business, and that core business continues producing exceptional results. Every year, advertisers spend billions of dollars trying to reach consumers. Meta gives them direct access to billions of users across multiple platforms. Few companies possess that kind of reach. Even fewer possess the data required to make advertising highly effective. This is where AI becomes particularly important. Many investors think of AI as a separate business initiative. In reality, AI is already improving Meta's existing business. The company's recommendation systems determine what users see in their feeds. Its algorithms help advertisers target the right audiences. Its models optimize engagement and advertising performance. Every improvement increases the value of Meta's platforms. Better recommendations keep users engaged longer. Longer engagement creates more advertising opportunities. More effective advertising generates higher revenue. It's a powerful cycle, and artificial intelligence strengthens every part of that cycle. That's one reason Meta's revenue growth remains so impressive despite its enormous size. The company is using AI not only as a future growth driver but also as a tool to improve its current business. And when you consider the scale involved, even small improvements can translate into billions of dollars. Imagine increasing engagement across platforms used by billions of people. Imagine improving ad targeting for millions of advertisers. Imagine helping businesses generate better results from their marketing budgets. Those benefits compound quickly. Now let's address the biggest reason some investors remain hesitant. The concern isn't whether Meta's current business works. Everyone can see that it does. The concern is whether all this AI spending will eventually produce meaningful new revenue streams. That's the question hanging over the stock today. And interestingly, that's also where much of the upside may come from, because expectations appear relatively modest. Many investors are assuming that Meta's AI initiatives will take years to prove themselves. Some believe the returns won't justify the costs. Others simply don't know what successful monetization will look like. But imagine for a moment that Meta announces a genuinely successful AI product. Maybe it's an AI assistant that reaches massive adoption. Maybe it's a business productivity tool. Maybe it's a creator platform. Maybe it's an entirely new category that doesn't even exist today. The specific product almost doesn't matter. What matters is proof. Proof that Meta can transform AI spending into meaningful revenue. If investors receive that proof, the market's perception of the company could change very quickly, because suddenly Meta would no longer be viewed as just an advertising giant investing heavily in AI. It would become an AI winner with a thriving advertising business attached. That's a very different narrative, and stock prices often move dramatically when narratives change. The irony is that investors don't necessarily need that outcome for Meta to work as an investment. The advertising business alone remains extremely attractive. Think about the company's competitive advantages, network effects, scale, user engagement, global reach, advertising infrastructure, data advantages. These are not assets that competitors can easily replicate. Building another social media platform is difficult. Building one with billions of active users is nearly impossible, and that's why Meta continues attracting advertisers. Advertisers go where the audience is. The audience remains firmly inside Meta's ecosystem. What's especially remarkable is how resilient that ecosystem has become. Over the years, critics repeatedly predicted Meta's decline. Some argued younger users would abandon the platforms, others worried about competition. Some questioned long-term growth prospects. Yet the company continued adapting. Instagram expanded, Reels gained traction, WhatsApp grew, Threads emerged, revenue climbed, profits increased, and management consistently found new ways to monetize user attention. That ability to adapt is a major reason investors shouldn't underestimate Meta. The company has repeatedly proven capable of evolving alongside changing consumer behavior, and in technology, adaptability often matters more than any single product. Now let's bring the conversation back to valuation. Because growth and competitive advantages are important, but price ultimately determines investment returns. A great business can still be a poor investment if it's too expensive. Fortunately, that's not the situation here. Meta's valuation remains surprisingly reasonable relative to its growth profile. You're looking at a company growing revenue more than 30%, generating substantial profits, producing enormous cash flow, maintaining one of the strongest advertising ecosystems in the world, and investing aggressively in what could become the next major technology platform. Yet the stock still trades at a meaningful discount compared with what many investors might expect. That's why some analysts view the shares as undervalued. The market appears focused primarily on the costs associated with AI spending, but markets sometimes overemphasize short-term expenses while underestimating long-term opportunities. We've seen this pattern before. Companies invest heavily. Margins temporarily come under pressure. Investors become concerned. Then years later, those investments begin generating substantial returns. The stock eventually reflects the improved outlook. Could that happen here? Absolutely. Will it happen? No one knows for certain, but that's exactly why the opportunity exists. If the outcome were guaranteed, the stock would almost certainly trade much higher. Investing often involves identifying situations where the market's fears have become larger than the actual risks. Meta may fit that description today. The company has a dominant core business, strong revenue growth, massive cash generation, a huge user base, and significant AI optionality. That's a compelling combination, and perhaps most importantly, investors aren't being asked to pay an extreme valuation for it. They're buying a proven business with multiple paths to future growth. That's what makes Meta so interesting right now. You have a company generating extraordinary results today while simultaneously building capabilities that could create even larger opportunities tomorrow. And if management succeeds in turning those AI investments into meaningful products, today's valuation could eventually look very conservative. But the third stock on our list may be the most misunderstood AI investment of them all. Because despite dominating the AI hardware market, many investors still believe this company is overvalued. The numbers tell a very different story. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third AI stock that still looks cheap today is Nvidia, ticker symbol NVDA, and this may be the most controversial pick on the entire list, because if there's one criticism that continues to follow Nvidia everywhere, it's this: the stock is too expensive. You've probably heard it countless times. People look at Nvidia's incredible rise over the past several years and immediately assume the opportunity is gone. They assume all the future growth has already been priced in. They assume the valuation has become disconnected from reality. But when you actually examine the numbers, that argument becomes much harder to defend. In fact, Nvidia may be one of the most misunderstood stocks in the market today. The company sits at the center of the AI revolution. Its chips power many of the most advanced artificial intelligence systems in existence. Major technology companies are spending hundreds of billions of dollars building AI infrastructure, and much of that spending ultimately flows toward Nvidia. Yet despite this dominant position, the stock's valuation is far more reasonable than many investors realize. Let's start with a simple question. What does overvalued actually mean? A stock isn't overvalued because it has gone up. A stock isn't overvalued because a company becomes popular. A stock is overvalued when the future growth prospects fail to justify the price investors are paying. That's the key distinction, and when we apply that framework to Nvidia, the story becomes much more interesting. Currently, Nvidia trades at approximately 23 times estimated earnings for this fiscal year. Yes, that's slightly higher than the broader S&P 500, but only slightly. Think about that for a moment. The company that dominates AI hardware, the company supplying critical infrastructure for one of the biggest technological transformations in modern history, the company delivering extraordinary growth, trades only marginally above the market multiple. That doesn't sound particularly expensive. In fact, it sounds surprisingly reasonable, especially when you consider what's expected next. Wall Street estimates that Nvidia could grow roughly 41% next year. 41%. That's an extraordinary growth rate for a company of this size. And here's where things become even more compelling. Many investors continue focusing on Nvidia's current valuation without fully accounting for that future growth. They're looking at today's earnings multiple while ignoring how quickly earnings themselves may expand. But earnings growth changes everything. Imagine two companies trading at similar valuation multiples. One grows earnings by 5%, the other grows earnings by 40%. Over time, the faster-growing company can justify a much higher share price because its earnings power increases dramatically. That's why growth matters. And Nvidia's projected growth remains among the strongest anywhere in the market. What's fascinating is that the stock doesn't appear to fully reflect that potential. If Nvidia delivers anywhere close to current expectations, investors buying today could benefit as earnings continue catching up with the company's enormous opportunity, and that's before considering the possibility that Wall Street's projections are actually too conservative, which is entirely possible. Let's step back and look at the broader picture. Artificial intelligence isn't a single product. It's not a single application. It's not a single trend. It's an entire technological ecosystem that's still in the early stages of development. Companies around the world are racing to integrate AI into their operations. Governments are investing heavily. Cloud providers are expanding infrastructure. Enterprises are deploying new systems. Startups are launching AI-focused products. And nearly all of these initiatives require computing power, massive amounts of computing power. That's where Nvidia enters the picture. Its hardware has become the foundation upon which much of today's AI ecosystem is built. The company's chips are not simply products, they're enabling technologies. Without advanced computing infrastructure, many AI systems simply cannot function at scale. That creates extraordinary demand, and demand remains one of the most important variables for any business. When demand consistently exceeds supply, strong financial results often follow. Nvidia has benefited tremendously from this dynamic, but what makes the story particularly interesting is that AI adoption still appears to be in its early innings. Many organizations are only beginning to explore how AI can improve productivity, reduce costs, and create new business models. As adoption expands, demand for computing infrastructure could continue rising for years. That doesn't guarantee Nvidia will capture every dollar spent. Competition will exist, technology will evolve, markets will change. But Nvidia currently possesses advantages that are difficult to ignore. Its ecosystem is deeply established, its software tools are widely adopted, its relationships with major customers are strong, its technology leadership remains significant. Those advantages create barriers that competitors must overcome. And in rapidly growing markets, early leadership can be incredibly valuable. Now let's talk about investor psychology, because psychology often drives stock prices just as much as financial results. Many investors missed Nvidia's initial surge. They watched from the sidelines as the stock climbed higher. And when people miss a major winner, they often develop a natural bias against it. They start looking for reasons why the stock must be overvalued, why the growth must slow, why the opportunity must be ending. It's understandable. Nobody likes feeling late. But investing isn't about comparing today's price with yesterday's price. It's about comparing today's price with future potential. That's a very different exercise. The market doesn't care where a stock traded 3 years ago. The market cares about where earnings, cash flow, and business value are headed next. And when viewed through that lens, Nvidia remains extremely compelling. Remember, Wall Street expects approximately 41% growth next year. Yet that future growth doesn't appear fully reflected in the current valuation. That's precisely why some investors continue seeing opportunity despite the stock's past performance. They're focusing on future earnings power rather than historical returns. And there's another reason Nvidia deserves attention: scale. One of the biggest misconceptions in investing is that large companies cannot continue growing rapidly. History repeatedly proves otherwise. The largest opportunities often become available when a company dominates a massive and expanding market. That's exactly what Nvidia appears to be doing. Artificial intelligence isn't a niche industry. It has the potential to impact healthcare, finance, manufacturing, transportation, education, entertainment, cybersecurity, scientific research, and countless other sectors. every major industry is evaluating how AI can improve efficiency and create competitive advantages. The broader the adoption becomes, the larger NVIDIA's addressable market may grow. That's why some investors believe current growth projections could ultimately prove conservative. Not because management needs to perform miracles, not because unrealistic assumptions are required, but because AI adoption itself may exceed expectations. If that happens, NVIDIA stands in a strong position to benefit. Of course, no investment is risk-free. Competition remains a factor. Technology changes rapidly. Economic conditions can influence spending, and expectations always matter. But investing isn't about eliminating risk. It's about finding situations where potential rewards outweigh those risks. NVIDIA appears to fit that profile. You have a company with market leadership, strong growth, a reasonable valuation relative to future earnings potential, and direct exposure to one of the most important technological trends of the next decade. That's a powerful combination. And when investors look back several years from now, they may be surprised by how reasonable today's valuation actually appears. Which brings us to the bigger takeaway from this entire video. Microsoft, Meta Platforms, and NVIDIA. Three completely different businesses, three different approaches to artificial intelligence, and three opportunities that still appear attractively valued despite AI dominating financial headlines. Microsoft gives investors exposure to cloud infrastructure, enterprise software, and a rapidly growing AI ecosystem. Meta provides a dominant advertising machine with significant AI upside that may not yet be fully appreciated by the market. NVIDIA offers direct participation in the hardware foundation powering much of the AI revolution. Each company possesses massive competitive advantages. Each company generates substantial cash flow, and each company appears better positioned for the future than current valuations might suggest. That's why the smartest investors often focus on a simple principle. They don't just buy great businesses, they buy great businesses when the market temporarily underestimates them. And right now, Microsoft, Meta, and NVIDIA all have arguments supporting that case. The AI revolution is far from over. In many ways, it's just getting started. The question isn't whether artificial intelligence will reshape the economy. The question is which companies will capture the most value along the way. These three businesses already have enormous advantages. They already have scale, they already have customers, and they already have the financial resources necessary to keep investing for the future. That's what makes them so compelling today. Not because they're guaranteed winners, nothing in investing is guaranteed, but because the combination of quality, growth, and valuation still looks remarkably attractive for investors willing to think beyond the next quarter and focus on the next several years. And sometimes that's exactly where the biggest opportunities are found. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we wrap up, I want to hear from you. Which of the companies in this video do you think has the strongest long-term competitive advantage? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.